Welcome back to Switzer. Last time my next guest was on the program, he indicated that material stocks was the place to be going forward. Given the pressure the sector's been under, has he changed his tune? From Woodhall Investment Research, we have Ron Bewley, Professor Ron Bewley, I prefer to call him, sharing his investment wizardry with us tonight. How are you, mate?
I'm good, and I did buy materials, and I'm happy I did.
Yeah?
I didn't buy at the cheapest price, but if you're a long-term investor, you can't play that game too much. Yeah. I could have waited another few days, but I got a reasonable price, and it's back to about what I paid for.
Yeah,
just a fraction under.
And I guess what people are wondering, what was the thinking behind supporting materials at the time?
Well, two things. My quant work, which shows the sector's very underpriced.
Quantitative analysis.
Sorry.
Quant work. So the normal people out there.
Normal people, sorry.
Okay.
Quantitative research.
Yes.
Tells me, but also my own sort of idea of interpreting what people are saying in the marketplace.
You were only the investment officer at ComSec once upon a time.
Yes, so I used to build portfolios, and in fact I'm managing some money for people now. I'm helping out and things, so I do that for a living, too, but only part-time.
Okay.
So, see, I think the China story is overblown. I think they tend to manipulate, not illegally manipulate, but they do what a car dealer does. When you try to buy a car off them, they pretend they're going to sell it for that price and then another one, so it goes up and down. So yeah, it may not take off for a little while, but at some point, like Woodside suddenly took off the other day, suddenly things happen and come through. So you've got to sit and wait and buy at a good price.
Yeah. So you've got a whole lot of charts. Before we start looking at the charts, is there anything else you'd like to say around, you know, the material issue, the energy issue?
Yes. You know, but maybe the viewers don't know, I follow consensus forecasts from Thomson Reuters very closely. I look at them all. And
that gets together all hundreds of analysts.
And I don't see how I can beat
people who specialise, and you try to...
And my skill is bringing them together in a better way.
And get some sort of average view out of it. Yep.
And I have these little files I fire up every morning. Yep. And what I've noticed in the last few weeks, in fact, I think it was 3 weeks ago, every one of my stocks got upgraded.
Every one of them?
Every one of them, including the materials one.
Yeah.
And again, now, so they're being upgraded, but the prices aren't being upgraded, they're just saying they're cheap. Yeah. And to my mind...
Well, because Macquarie's got BHP as an outperform.
Yeah.
Yeah. And because the price is cheap.
Yeah.
Yeah.
And it was cheap a month ago.
Yeah.
So it's a question of when you go in there, because the trouble is, somebody like me, if a price goes up like a Woodside many percent in one go, I don't want to buy them because I think I've been cheated. I'd rather buy it goes down a bit and then comes back up.
Yeah, yeah. But that is you, Ron. That's not necessarily a recommended investment attitude, is it?
But that's the way I did it at the bank. Yeah. We got people in gently going sort of down in nice clumps rather than just following any old price and going in. So timing in and timing out.
Yeah, really average cost.
And we reckon we made alpha about 2 or 3% a year out of that.
Yeah. Okay. So let's go to the chart before we run out of time.
First chart. So this is an update of a chart I used 2 months ago here. Yeah. And it's the ASX 200. And instead of using a squiggly line, I use a dot for each day.
Yes.
And each dot is color-coded by whether the market was cheap, expensive, or on par.
Okay. So what's red?
Red is the danger signal. Yeah. And it's on your website, and it was on your show, saying that this market, because it hit about 51.50, I think it was, between friends.
It was
so it's got to correct or move sideways for a long time. It turned out to be more or less the right story. So it went up there a little bit and down a little bit, and the green is par, so that was a good buying opportunity.
Yeah, so you like it when it's green.
Oh, yes.
It's a good time to buy. That's when Ron Bewley says, you little beauty.
Yeah, I would buy when it's black, but not usually. I'd have to have a good reason. I wouldn't buy when it's yellow or red.
So we're black at the moment, is that what you're saying?
Yes, so you can just about get in, depending on the things.
Yeah.
But I'm going to tell you a sectoral story if I can get it all in.
Of course, yes.
But the whole thing to point out here is that this chart was finished on Friday. Okay. Because it looked good.
And we've had 2 good days since then.
So that's the same number basically as it was back at the red dot. But the important thing is this isn't a red dot anymore because the market's come up, so the fundamental has risen nicely over those 2 months, so it's no longer, it's not even yellow.
When you say the fundamental has risen?
The fair price.
The fair price. Good.
Because I pronounce fur from the north of England, nobody knows what I'm talking about.
So, I'll try and interpret you. Okay, let's go to the next chart.
So now this is very simple. This is just between that show and this one, what's happened to all the prices. And I've grouped the sectors with some loose names like resources. They're not totally resources, but you'll see they've all been hammered. So we're back 51.50 to 51.50, but they got hammered. Material 16% down. Yeah, yeah. And energy was down.
So the fact it's been hammered, what does that tell you, Ron?
Nothing.
Good. I thought you'd say that.
Absolutely nothing.
So what
and that's the point of what I'm trying to talk about tonight.
Yeah.
I'm glad you brought that up.
Okay, so what's the conclusion then?
Can I not get there first?
You can develop.
Give me a minute or two
Okay,
when
do.
the end's coming. But you'll see in the high yield sector, which is what we talked about dividend players last time, 5, 5, 9, 7. Importantly, Telstra 9, or Telco 9, twice the rate of the banks over that period.
Yeah.
And then other, because there's no other word for them, 7, 7, 5, 1, they're more or less the same, bit hodgepodge. So it's definitely been a market of two parts, not halves. And resources got hammered, the others more or less did all right.
Yes.
But the market is level at the same point. Yeah?
Okay, fine.
So if we now go to the next slide, if we may, this is an update of 1 month over the last time I spoke on this program with you.
Okay.
And the whole point here was I was saying that the high yield sectors were massively overpriced and should correct.
Yes.
Except I think it's now a dividend play. And what it is the compressing yields down to a common point. And if you
let's go to the chart, guys.
On the left hand side you see Telstra at the top is about 8.25 at the start of 2012.
That's the red.
Yeah, and then you go down to about 6 and a bit. So it's a 2% spread. And then when I was on the show last month, you go back one from the right and you'll see 3 of them, that is excluding Telstra, so that's financials, properties and utilities, were all 5.5 to 1 decimal place. So they're being compressed down to that because people will do anything to get yield to get out of cash. So they're prepared to pay too much. So that's eroding their chance of getting capital gain.
Okay, so you're saying,
forward.
so are you saying that because there's been an enormous chase for yield, it's likely the law of diminishing marginal utility will eventually come in here? Less satisfaction.
Unless the dividends go up as ANZ did today, and that gives them a second wind. But you'll see in the 1 month coming forward, remember Telstra got 9% and the banks 5%. It's come down further to meet them. We talked about you could still buy Telstra a bit, and we talked about $5 being a price. So it wasn't quite compressed down to the 5.5.
Well, the banks are still around probably 4.5. 5.
But they can't, I think, get much lower because you've got to have equity risk premium. You're taking on capital gains risk, so you've got to do something about that.
Exactly right.
It would not be smart. But I did say last time I wouldn't sell my banks. Because
you already bought a lower price.
I got a lower price. I'm taking the yield, and if it goes up and down, I'm still getting that yield.
Let's go to the final chart before
this is the answer to your question before. So you'll see in the blue oval, that's materials. When the market was 51.50 2 months ago, it was only just overpriced, 0.7%. Almost exactly fair price. It got knocked down 16% and now it's 18% cheap. So it's still good buying. And that's why I like it. Really, really cheap. But if you then go to the red one, which is financial, so they're the banks, it was 14.6% overpriced 2 months ago, which is a dangerous signal. The price of the stock has gone up 5%, but the exuberance has gone down because the upgrading of the fair price of the banks. So they're actually justifying some of that price rise. So it's not just silly exuberance. Some of it is actually a payment for good economic performance. You have to measure that, otherwise you're waving your arms around. And then, but property underneath, you see that's gone up in, that also did 5%, but that's gone up in overpricing. So you can't just say the market was 51.50, 51.50, everything's the same. Complex things are changing all the time.
So, Ron, what is a warning sign number in terms of exuberance for you?
6%.
6%. So at 14.6, financials were a real worry to you there.
Except the
now
dividend
delivered.
And that's on your website. And by the way, all these charts are on my website if people can't read them at a distance. So if you go into my woodhall.com.au. So for the high yield sector, but I can't justify a 9.8 for staples and a 7.6 for discretionary, and they may have been higher. So they look like a problem to me because the yields are quite low. 3 or 4 maybe.
Okay, so what is your expectation for the market going forward over this year? Like I said earlier today, I've had a 5,500 number out there. Are you with me on this one?
No, I'm slightly less than you this time. But I haven't budged from before. See, the fair price is about 49.75 I got for today. We're about 3% over, 3.5% overpriced. So we could easily grab another 100 points without any tears. But we can't grab too much more until we go sideways for a 1, then we can take a next rally. So I'm still looking at 53.50 is like my number. But if we're 6% over, which we could be, that would take me up to 56, 5,700, which would be even above you. So if we happen to finish the year over exuberant a little, we could do that without tears. So I'm looking at something like 53.50, but it could easily be 56,
You'll accept
57.
5,500 if it happens to come your way.
Yes.
All right,
and I'd
buddy.
like it too.
Okay, mate, fantastic. So,
Pleasure.
a lot of your stuff is on my website, switzer.com.au.
Yes.
And you write for the Switzer Super Report, and also your website
I
is?
put one on this stuff yesterday in your Super Report.
Okay, fantastic, mate. Great talking to you as always.